You hear it all the time, right? On the news, online, the market is up, the market is down. We hear the word stocks thrown around constantly. But what does it all actually mean? Well, if you've ever felt like you're missing a key piece of the puzzle, you're in the right place. Today, we're going to put that puzzle together, starting with the most basic building block of them all, the stock.
I mean, that's the big question, isn't it? Beyond all the squiggly lines on the charts and the complicated numbers, owning a stock means you own a little piece of a company. But what does that really get you? Let's break it all down.
So here's our game plan. First up, we're going to nail down exactly what a stock is. Then we'll get into the nitty-gritty of what that ownership actually means. We'll compare the different types, like common and preferred, see how they're different from bonds, and then, the best part, we'll get to how you can actually make money from all this.
All right, let's dive into our first section, what even is a stock? And to get it, you got to go back to the very beginning. It all starts with a company that has big ideas and wants to grow. And for that, it needs money.
Okay, so here it is. The official definition. A stock, which you might also hear called an equity or a share, is a security that represents ownership of a tiny fraction of a company. That word right there, ownership, that is the key to everything. You're not just betting on a company, you're literally buying a piece of it.
And you know, the easiest way to think about this is with pizza. Seriously, imagine a massive company like Apple or Amazon is one giant pizza. When you buy one share of stock, you're buying a single slice. Now, you don't own the whole pizza shop, but that one slice, that's all yours.
So you might be asking, why would a company sell off these valuable slices of itself? Well, it all comes down to raising cash, or capital, as they call it. They offer up these small pieces of ownership to investors like you and me to get the funds they need to run the business, maybe expand to a new country, or fund that next game-changing project.
Okay, so you've got your slice of pizza. Awesome. But what does that actually mean? Can you just walk into their main office and take a cool chair home? Well, not quite. Let's dig into what a share really gives you.
This is a super important idea to grasp, and it's called the separation of ownership and control. A corporation is basically its own legal person. It can own stuff. So the company itself owns the buildings, the computers, all the physical assets. As a shareholder, you don't own the furniture. What you do own are the shares, and those shares give you a claim on the company's assets and, more importantly, a piece of its future profits.
So what are the perks? What do you actually get with that slice? Well, a few key things. First, you get a voice. You have the right to vote on big company decisions like who's on the board of directors. Second, you might get a piece of the profits, which are paid out as dividends. And third, it's yours to sell. You have the right to sell your share to someone else whenever you want. Now, here's where it gets a little more interesting. It turns out that not all slices of that pizza are created equal. There are two main flavors you're going to run into, common stock and preferred stock. And it all comes down to a really simple trade-off. Common stock is what most people own. It gives you voting rights, you get a say. Preferred stock, on the other hand, usually doesn't give you a vote, so why would anyone want it? Because you get VIP financial treatment. Preferred shareholders get paid their dividends first, and if the company, goes bankrupt, they're ahead of the common stockholders in line to get their money back. Okay, let's clear up another huge point of confusion. You always hear stocks and bonds said in the same breath, but they are fundamentally different things. The easiest way to remember it is this. With a stock, you're an owner. With a bond, you're a lender. Think about it. When you buy a stock, you're an owner. You're buying into the company, sharing in its potential wins and its losses. It's riskier because if the company fails, owners get paid last. But when you buy a bond, you're just acting like a bank. You've given the company a loan, and they have a legal obligation to pay you back with interest. It's generally safer. One is a bet on future growth, the other is a loan with a promise.
Okay, we've covered the what, the why, and the what-ifs. Now for the fun part. The question everyone wants to know. How do you actually make money doing this? Well, there are really two main ways it happens.
Path number one is through dividends. If the company is doing well and making a profit, it might decide to share some of that profit with its owners. So for every share you own, they'll send you a little cash payment. Path number two, and the one you hear about most, is capital appreciation. This is just a fancy way of saying the price of your stock went up. Your slice of pizza simply became more valuable. You bought it for, say, $10, and later someone else is willing to pay $15 for it. That $5 difference, that's your profit.
And it's that potential for growth, that capital appreciation, that it's just so powerful. Now, of course, this is not investment advice, but it's a pretty incredible historical fact.
Over long periods of time, stocks as an asset class have tended to grow more than most other types of investments. It's that potential that gets so many people excited about owning a piece of the pie.
So there you have it. We went from a confusing word to a slice of pizza to a real claim on a company's future profits. You now get the what behind a stock, and that's the foundation for everything else. The bigger question is, what are you going to do with this knowledge? Because now that you get the fundamentals, the real journey into the how and why of the markets can truly begin.